Imagine this. A founder is starving in a palace made of ideas. The product is brilliant. The market is warming up. The users are finally arriving. But the bank account? Breathing like a man climbing stairs with asthma. Then one day, a black car door opens. Out steps capital. Not money in the abstract, not a spreadsheet, not a polite investment memo. No, capital arrives like an elegant stranger in a tailored suit, holding a glass of water in one hand and a contract in the other. And it says, "Drink, you look thirsty. All I want is a little piece of the kingdom." That is the moment many founders think they're making a money decision. But they are not. They are making a power decision. Because cash can save your company, but the wrong equity deal can quietly take your company away from you. And the terrifying part? It usually doesn't happen in one dramatic betrayal. It happens in percentages, in board seats, in protective provisions, in clauses so boring they could put a caffeinated lawyer to sleep. And yet, hidden inside those dull, harmless-looking paragraphs is one of the oldest stories in human history. The story of a king who sold pieces of his crown to pay for tonight's dinner, and woke up one day to discover he still wore the robe, but no longer ruled the throne. Today, we're going deep into the real cost of giving up equity, why it can cost more than money, how founders lose control without selling the whole company, and how to think like a builder instead of a beggar. Let's begin. There's a dangerous illusion in business that ownership and control are the same thing. They're cousins, not twins. You can own a meaningful slice and still be overruled. You can own less than 50% and still control the company. You can be rich on paper and powerless in reality. That sounds absurd until you realize many of the biggest companies on earth were built around this exact truth. Some companies use multi-class share structures, where one type of share carries far more voting power than another. And the lesson is simple. In business, the check you cash and the control you keep are not automatically proportional. If you don't understand that, you can mistake financing for success, right up until the day you are politely escorted out of your own vision. Ask Steve Jobs. You can create the future, but you can still lose the meeting. The temptation of cash. Let's be fair to founders. Cash is not a luxury. Cash is oxygen. Payroll is due. Servers must run. Ads cost money. Engineers do not accept vision as rent payment, not even the ones who wear hoodies and call themselves mission-driven. So when investors show up, the offer feels like salvation. Take this capital, hire faster, grow faster, capture the market before someone else does. And sometimes that's true. Capital can absolutely accelerate a good business. But here's where the seduction begins. Founders often ask, "How much money am I getting?" when the more dangerous question is, "What am I giving up?" besides the percentage. Because equity is not just a fundraising tool. Equity is a transfer of future upside, voting power, board influence, negotiation leverage, and in some cases, the right to decide what your company even becomes. A founder thinks, "I'm only giving up 20%. Only? That word has ruined many cap tables, because dilution compounds like a silent tax. A little in the seed round, a little in the A, a little in the employee option pool, a little in the next raise, a little in the bridge, a little in the "we just need 12 more months." And one day, the founder looks at the cap table the way a man looks at his old jeans after the holidays. How did this get so tight so slowly? Percentages lie when power is structured. Here is where the rabbit hole gets interesting. A founder can lose control in at least 3 different ways. 1. Economic dilution. This is the obvious one.
Your percentage ownership shrinks. If you started with 100% and after several rounds you're down to 18, that matters. Not just because your upside is smaller, but because your negotiating posture is weaker. 2. Board dilution. This one sneaks up on you. A term sheet is not just about valuation. It often defines who gets seats at the table. And if you find yourself outvoted, you can still be CEO and still lose the vote. A CEO who loses the vote is like a lion in a zoo. Impressive, photographed often, but the gates are controlled by someone else. 3. Protective provisions. This is the sophisticated trap. Even if you keep decent ownership and even if the board looks balanced, investors may still negotiate rights over major decisions. In plain English, certain people can say, "You can't issue new shares without us. You can't sell the company without us. You can't change key terms without us. You can't do something major without our blessing." So the founder still has the title, but the real message becomes, "You may drive the car. Just know we installed the brakes, the steering lock, and a remote kill switch." The ancient kingdom problem. Let's turn this into a story. A young ruler inherits a struggling kingdom. The walls are cracked, the army is underfed, traders are bypassing the capital, the treasury echoes when you open it. Then wealthy nobles approach. They offer gold. Not as a gift, of course. Nothing in history has ever been free, except bad advice. The first noble says, "I'll fund your army. I only ask for a small stake in future tax revenue." The second says, "I'll rebuild your ports. Just let my family appoint one advisor to your council." The third smiles and says, "I believe in your vision. All I ask is veto power on matters of strategic significance." The king agrees, and he feels clever. The army is restored, the ports are alive, the city shines. For a while, he looks like a genius. Then a drought comes. He wants to redirect grain. The nobles object. He wants to raise a new levy. The council blocks. He wants to fight. They want to wait. He wants to hold. They want to sell. Now the kingdom is bigger, but the throne is smaller. That is the founder's dilemma. The more external capital enters, the more the company can grow. But if governance isn't designed carefully, scale can magnify not just success, but dependency. And dependency changes behavior. A founder who once built boldly begins managing politically. They stop asking, "What is right for the mission?" and start asking, "What will pass the board?" That is the psychological turning point most people miss, because the greatest cost of bad equity is not just dilution, it is mission drift under financial supervision. When cheap money becomes expensive money. Now here's the twist. Many founders think equity is safer than debt because there are no required repayments, no monthly loan pressure, no interest meter ticking like a bomb. And in cash flow terms, that's true. But in long-term wealth and long-term control terms, equity can be the most expensive money you ever take. Let's say someone offers you $500,000 today for 20% of your company. In the moment, that feels survivable because your company is small, fragile, uncertain. But if that company later becomes worth $50 million, that same 20% was not just $500,000, it was $10 million of future value. And that's before we even price in governance influence. So the real cost was never the headline check. It was the future you sold at yesterday's level of desperation. That's why smart founders don't merely ask, "How much runway does this buy?" They ask, "What is the implied price of my future? What rights come attached? What decision-making muscle am I outsourcing? Am I selling fuel or am I selling steering?" Because there's a difference between raising capital and pawning destiny. And yes, sometimes you must take the deal. This isn't a fairy tale where bootstrapping magically solves everything and every founder survives on noodles, caffeine, and inspirational tweets. Sometimes the company needs capital. Sometimes speed matters. Sometimes the market window is closing. Sometimes a competitor with deeper pockets is already sprinting. But necessity does not eliminate cost. It only explains why people pay it. Control is not ego. Now let's address the criticism. Whenever founders talk about maintaining control, someone eventually says, "Ah, so you just want power. Sounds like ego." Maybe. Sometimes it is ego. Some founders confuse discipline with dictatorship. Some want absolute control because they cannot tolerate being challenged. That is not leadership. That is insecurity wearing a black turtleneck. But control is not always ego. Sometimes control is stewardship, because the founder often holds something others don't, the original thesis,
The non-obvious conviction. The willingness to endure temporary ugliness for long-term payoff. The emotional endurance to keep building when outsiders panic. Investors may be brilliant. Some are. But investors can have different incentives. Their fund timelines matter. Their portfolio construction matters. Their return targets matter. Their appetite for risk changes with macro conditions, not your dream. You are building your life's work. They are managing an asset. That doesn't make them evil. It makes them structurally different from you. And if you forget that, you may assume alignment where only overlap exists. A handshake can be warm, while incentives remain cold. The boardroom is a theater of polite war. Let me paint the scene. Conference room, glass walls, sparkling water, slide deck. The founder enters believing this is a strategy session, but hidden beneath the polished language is an older ritual: territory. Every sentence sounds civilized. Have we considered strategic alternatives? Should we evaluate leadership scaling needs? Would a more seasoned operator help the next phase? Is now the right time to maximize shareholder value? And translated into plain human language, that can mean sell now, replace the founder, slow the vision, optimize for returns, not purpose, do what protects capital, not what fulfills the mission. Nobody bangs the table. Nobody yells, "Seize the kingdom." That's not how modern power works. Modern power wears a blazer, smiles with excellent teeth, and removes you through procedure. Which is why founders who ignore governance because it feels less urgent than product are making a classic mistake. They are obsessing over the castle walls while signing away the drawbridge. How to take money without losing your soul. So what do? How do you raise money without becoming a decorative monarch? You think in layers. 1. Understand that valuation is only the front door. A high valuation can distract you from terrible control terms. A founder can brag, "We raised at an amazing price." Wonderful. And did you also give away board leverage, protective rights, and future flexibility? A shiny valuation can be like expensive cologne on a bad contract. It smells premium, but something is still rotting. 2. Model dilution across multiple rounds. Do not analyze one round in isolation. One round is a scene. Your cap table is a series. Ask, what happens after this round? After the next? After the option pool refresh? After a down round? After pro rata participation? You are not negotiating for today's pie slice. You are negotiating for your place at the table after the pie gets recut 5 times. 3. Defend board composition. This is not paranoia. This is architecture. Who appoints directors? How many investor seats? How many common or founder seats? Is there an independent? And who really influences the independent? Remember, a board seat can outweigh a chunk of economics in practical control.
4. Read protective provisions like your future depends on them, because it might. If key actions require preferred approval, then your company is no longer governed only by common logic. It is governed by negotiated consent. 5. Match financing type to company stage. Not every problem requires equity. Sometimes revenue financing, debt, slower growth, pre-sales, partnerships, or staged expansion preserve more long-term value. The wrong founders ask, "What funding can I get?" The wiser founders ask, "What funding structure best fits the business I'm actually building?" 6. Choose investors like co-authors, not ATMs. Because once they're in your story. And some people give money the way some people give relationship advice, enthusiastically, confidently, with zero intention of living with the consequences. The tragedy of winning the round and losing the company. Here is the deepest irony in startup history. A founder can win fundraising and lose everything that mattered. Big round, press coverage, applause online, congratulations from people who were ignoring you 6 months ago and will ignore you again the moment the trend shifts. But internally, you may have traded independence for acceleration, conviction for consensus, ownership for optics, vision for velocity. And velocity is seductive because speed feels like power, until you realize you're moving very fast in a direction chosen by committee. That is not entrepreneurship. That is corporate horseback riding, where you're technically on the horse, but somebody else has the reins, somebody else owns the saddle, and 3 people in Patagonia vests are debating whether you should even still be riding. So what is the real lesson? Cash solves short-term pain. Control determines long-term destiny. Money can rescue a business quarter. Control decides what the business becomes over a decade. And when people say it's only equity, they're speaking as if equity were just arithmetic. It is not. Equity is compressed future. It is bottled power. It is tomorrow negotiated by the desperate version of you today. That's why giving up equity can cost more than money, because you're not only selling upside, you may be selling authority, freedom, strategic patience, replacement risk, and the right to say, when the moment comes, "No, this is still my call." Resolution. So, if you're building something right now, hear this carefully. Do not fear capital, but do not romanticize it either. Money is a tool, not a savior, not a stamp of worth, not proof you were right, and definitely not free. Raise when the capital genuinely multiplies the business more than the dilution harms it. Raise from people whose incentives you understand. Raise with governance eyes open. And if you can preserve control while staying alive, do not underestimate how valuable that is. Because the world celebrates fundraising headlines, but history remembers builders who kept enough control to finish what they started.
If this hit you, then the next time you hear the phrase, just give up a little equity, you'll hear what it really means. Trade a piece of tomorrow for relief today. And sometimes that is wise. Sometimes it is fatal. The difference is whether you understood the price. If you want more stories like this, where business, psychology, power, and human nature collide, subscribe to the channel. Because in this world, the most expensive mistakes are rarely made with bad intentions. They are made by people who needed cash and didn't realize they were negotiating with their future self. And that future self? He always reads the fine print, too late.